Picture someone building serious wealth from scratch today. What do you see? You're probably imagining a tech startup, right? Some brand new, world-changing idea backed by venture capital, enduring years of heavy losses before a massive payoff, assuming that payoff ever actually comes. That glamorous, high-stakes picture completely dominates how we talk about entrepreneurship. But quietly, away from the flashy headlines, a totally different and highly practical path has been producing extraordinary returns for decades. And it's basically the exact opposite of a startup. Welcome back to Zach Wealth Files, I'm Zach. Today, we're doing a full explainer on how normal people are building multi-million-dollar holding companies by buying already profitable, completely unglamorous small businesses. We're talking plumbing companies, laundromats, and regional landscapers. Look, AI is cool, but a fleet of porta potties actually pays. By the end of this explainer, you're going to know exactly how the financing works, the real honest risks involved, and the concrete steps you can take to get started. Let's dive in.
Here's the part most people get wrong. They think starting from zero is the only way. But let's look at the fundamental case for buying an existing business. A genuine startup has a failure rate that studies put somewhere between 70 and 90%. You are betting on an unproven idea in an unproven market, and you're almost definitely burning cash. Now, compare that to buying a boring small business that has been quietly profitable for 15+ years. The whole product market fit question? It's already answered. The employees already show up. The customers already pay. What you're actually buying is a proven, de-risked cash flow machine.
And the financial data on this strategy is genuinely striking. Stanford's Graduate School of Business has been tracking a specific formalized version of this strategy, which they call search funds, since 1984. Their 2026 search fund study tracked 4 decades of real-world outcomes and found aggregate returns of a 4.75 times return on invested capital. Just process that for a second. That is not 4.75%. That is 4.75 times the money put in.
The data goes even deeper. That same Stanford study reveals a roughly 33.9% annualized internal rate of return across the entire dataset. This isn't just a handful of lucky outliers making it big and bragging on the internet. This is the documented aggregate of thousands of real-world acquisitions over 40 years. It's a legitimate asset class built on clear, repeatable mechanics.
The reason this strategy is having such a massive moment comes down to a once-in-a-generation macro trend. America has roughly 6 million small businesses with employees. And here's the crazy part. Around half of them are owned by baby boomers, who are now in their 60s and 70s. Over the next decade, millions of profitable, well-run, boring businesses are going to need new owners, simply because their founders are retiring, often with absolutely zero succession plan. They don't want a private equity firm to come in and strip the company for parts, and they certainly don't want to just shut their legacy down. They want a successor. For prepared buyers, this is creating a massive, unprecedented wave of available inventory.
So, how does a normal person actually finance a multi-million-dollar business purchase? Let's break this down level by level, starting with how these things are priced. First, we need to understand a term called SDE, or Seller's Discretionary Earnings. SDE is basically the total cash flow available to a single owner-operator. It's the business's net profit plus the owner's salary, plus any personal expenses they might run through the business, like a leased truck or cell phone. Small businesses typically sell for a multiple of this SDE number. According to recent BizBuySell data, these boring businesses sell on average for between 2.5 and 2.7 times their SDE.
But here is the real game changer, the financing piece that makes this whole thing accessible. The U.S. Small Business Administration has a program called the 7A loan. This program can finance up to 90% of a qualifying small business acquisition. That means an ordinary buyer can step in, take over a highly profitable company with as little as 10% down. The rest is covered by an SBA-backed loan, usually on a 10-year term.
Let's make that super concrete with a real-world example. Imagine you find a well-run HVAC company that generates $400,000 a year in SDE. Using that average 2.7x multiple, the total purchase price is going to be roughly $1.1 million. With the SBA 7A loan structure, you as the buyer only need 10% down. That's $110,000 in actual cash to control a business that is throwing off $400,000 a year in cash flow.
Now, I know what you're thinking. Zach, what about the loan payments? Well, this math perfectly illustrates the power of the framework. After paying the debt service on that SBA loan, which at current historical rates might be roughly $130,000 to $150,000 a year, the business still produces over $250,000 in net cash flow for you. Think about that. Your initial $110,000 down payment is fully recovered in year 1. Meanwhile, the business itself is paying down the loan for you. This first acquisition, it's the first domino in building serious multi-generational wealth. Once you've successfully stabilized that first domino, the strategy shifts because the real leverage happens after the first deal. Level 2 is the paydown period. In years 1 through 3, you run that HVAC company competently. You use the cash flow to aggressively pay down the acquisition debt. By year 3, you've built up enough equity and accumulated enough cash flow to fund the down payment on acquisition number 2. Maybe it's a plumbing company this time. By year 5, you have multiple stable businesses throwing off cash. It's exactly like a giant snowball rolling downhill. It compounds over decades, not quarters.
And at this level, a massive structural unlock happens. Instead of each individual business paying for its own separate bookkeeping, HR, and marketing departments, you consolidate. You centralize these back-office functions across your new holding company. This shared service model genuinely improves net margins across your entire portfolio, often pushing them from around 15% up to 18% or even 20%. Fun fact, this is the exact same playbook used by giant legendary firms like Berkshire Hathaway and Constellation Software. You're just applying it on a Main Street scale.
A core rule here at Zach Well Files is that we always talk honestly about the downside. A lot of internet content completely glosses over the failure modes of this strategy, but let me be incredibly clear. This is absolutely not passive income, and it is not risk-free. Leverage cuts both ways. If a business hits a rough patch, that SBA loan payment is still due every single month. Second, operational competence is non-negotiable. If you buy a plumbing company, you need to know how to manage blue-collar workers and deal with 3 a.m. on-call schedules. Third, skipping due diligence will absolutely land you with hidden liabilities. Fourth, the transition period is incredibly fragile. Coming in and arrogantly changing everything on day one often destroys the very revenue you just bought. And finally, this capital is highly illiquid. You can't just panic sell a plumbing company on a brokerage app with one click. If you're prepared to respect those risks, how do you actually move forward? I want to give you a concrete, step-by-step framework so you know exactly what to do this week. Step 1. Build your financial literacy. Do not buy anything until you've analyzed at least 50 deals to deeply understand STE and multiples. Step 2. Choose an industry you already understand operationally. Don't buy a landscaping business if you've never managed logistics. Step 3. Assemble your team. Find an attorney and a CPA who specialize specifically in small business acquisitions before you even have a deal on the table. And step 4. Be conservative on leverage. Just because a lender will give you 90% financing doesn't mean your specific business's cash flow can safely support it. Always keep in mind, this is general education. Always run your specific numbers with your licensed professional team.
The big takeaway here is that building significant wealth doesn't actually require inventing something brand new. It requires understanding proven mechanics. This strategy scales from a $110,000 down payment to a multi-billion-dollar holding company without ever changing its fundamental shape. Buy a profitable business, run it well, pay down the debt, and redeploy the cash flow into the next one.
It's real, it's mechanically understandable, and it relies entirely on clarity and facts, not hype. So I want to leave you with this question to think about today. Knowing the math, would you ever consider buying an existing business instead of starting one from scratch? Let me know down in the comments. I read every single one. If you want more clear, honest financial education that you can actually use to build long-term wealth, make sure to subscribe to Zach Well Files. Thanks for tuning in, and I'll see you in the next explainer.